All right, well, considering the consumer now, robust spending could lose steam as the savings they rely on start to run out. And with incomes not rising to match, consumers are set to buckle down and save as we turn into the new year. Well, joining us now is Stephanie Roth, JP Morgan Private Bank Senior Markets Economist. Welcome to the show, Stephanie. So as we try and get a gauge, we know that a lot of people are looking at this CPI print ahead of the Fed. But you say of the three things that the CPI makes up, there's one you're focusing on in particular, and that's services excluding shelter. Why is that?
Sure. So the three main points of the CPI that are worth noting: goods inflation, that's coming down. Leading indicators of that suggest that that's the case. COVID pandemic related factors were driving that up. That's coming out of the data. Shelter inflation, also not that important in the sense that leading indicators of real-time rents have been coming down, so we do expect shelter inflation to slow over the coming months. The Fed does expect that as well. So really what matters is service inflation excluding shelter, because that's the inflation that's tied to the labor market. The labor market's currently running too hot, and this is the part of the inflation dynamic that the Fed is going to be most worried about, because that is what's tied to this tight labor market that they're trying to slow down.
And it is worth noting that the CPI print, the Fed's forecasts were submitted before the CPI print, in case people are wondering about the impact of that. What are your expectations for the Fed announcement?
Sure. So we're expecting the Fed to be hiking by 50 basis points at the meeting. That's certainly consensus. The question is whether they're going to be hiking by 25 basis points in the February meeting, or if that will be 50 again. Then the question is also, where's the Fed's dot for 2023 going to be revised to? Expectations are just shy of 5%. That's in line with our expectation, but we do expect it to be revised slightly higher. So the question is really going to be, how is Powell going to be talking about the dynamics at hand? He certainly came across as dovish at the Brookings meeting, but we do think the conversation could be a little bit more hawkish this time around.
And Stephanie, I want to ask you about the consumer, because we have seen them be relatively resilient, but then you estimate that the consumer has around 3 months of excess savings before they run out. So with that then coinciding into a potential recession in 2023, what sort of economic domino effects could we be looking at?
Exactly. So the consumer has about $1.5 trillion worth of savings. What does that mean for regular people? That does translate to about 3 months worth of savings, at least for the bottom 60% of income earners. The bulk of the savings are really concentrated at the top, in which case those people have a low propensity to spend. So when we're talking about 3 months worth of savings, that will get us into the beginning part of next year. And yeah, you could get a handoff from real incomes, because now that inflation is coming down, consumers are earning a bit more money on a real adjusted basis. But that handoff is going to be really difficult. So our expectation is that the consumer is going to be slowing down at a time where financial conditions are really quite tight, and the economy is likely to slip into recession around the middle of next year.
And Stephanie, with that in mind, I mean, people seem to have at least something of a handle on what the Fed is going to do, barring any sort of extremes in the data. But I want to ask you about this, because Morgan Stanley's Michael Wilson called the CPI in the Fed meeting yesterday's news, and he said we should actually be focusing on earnings, which could contract more than expected into 2023. What is your take on that picture, and how we might see that playing out in the real economy?
Sure, I think that's really important. The conversation from earnings, especially when it comes to margins, is going to be critical. It's really going to be about the labor market dynamics. And if margins are not coming down, then companies are not going to slow down the pace of hiring. So it's really all about company margins and whether they're rolling over enough for companies to do more significant layoffs. Right now, it's mostly concentrated in the tech sector, which is related to overhiring during the pandemic. So we really want to see now, is our margins going to really result in a slower pace of hiring? Companies had so much trouble hiring during the pandemic, they're not going to be slowing down that pace unless their margins are really under pressure.
So, Stephanie, with that in mind, a lot of retail investors wondering what to do. According to Vanda Research, the average retail investor saw their portfolio shrink 30% in 2022. How is what they're doing different from what you're seeing institutional investors doing?
So one thing that we're recommending for clients and across the board would be adding duration to portfolios. Now is a great time to be adding yield. And on top of that, you could get a nice capital appreciation if rates just come down over the next year, which is our expectation. So it now is an exciting time to be talking about fixed income with all sorts of clients. There is stuff to do on the equity side. We're still a little bit more defensively positioned. we are talking about taking advantage of attractive valuations when it comes to small cap companies. But I would say the most exciting opportunities really are fixed income today.
All right, well, there you go. Opportunities still to be had in this market. A big thank you to Stephanie Roth, JP Morgan Private Bank Senior Markets Economist. Thank you for joining me this morning.